Okay, welcome everyone. We'll start our second lesson. Today lesson will go through LO2 Learning Outcome 2, which is about understand how organization manage cash flow and working capital. My name is Anjum Satar and my email address anjum@ukversity.co.uk. So any question before starting? If you have any. Okay, we'll start. So today lesson we'll go through LO2 and LO2 indicative content, what we're supposed to be discuss different factors that an organization will consider, allow credit to the customer. That's we'll go through. We'll discuss different model. Last lesson we discussed about Camry model as well. Our sources of finance. Welcome. Can you hear me? Okay, so okay, thank you. We'll start, please. Always good to be when we start any activities. Always rate yourself 1 to 10. How much we know about working capital? Do we know what is meant by working capital? Scale 1 to 10. What do you think? Where at the moment your current knowledge, please? 9. Okay, good. Okay, so next we'll go through 2.1 first. Okay, so 2.1 is about review internal and external some information used to evaluation of the credit status of customer. So when we evaluate the credit status of customer, what we need to do before authorizing the credit to our customer. So credit control is very important. So we need to be look around overall item, no credit at all, procedure of offering credit, obtain the reference, review the account information of the client, their accounts. You can visit the customer, look around the formal agreement, comply with the customer credit legislation. Probationary period, maybe you can give the low credit for some new customer and then you can enhance. And the settlement terms, maybe that can be varied based on the credit rating. And control age receivable analysis, we can chase slow payers. Okay, if you have any question, please you can ask. So second, we look around the assessment of the credit status. When we assess the credit status, what we need to do, we need to be look around the internal information, staff knowledge, customer visit, financial analysis, look around the request for the credit assessment procedures, and then you make the decision either the grant the credit or not. Okay, we can review our internal record and we can get the external reference to authorize credit to someone. Okay, next, sources of information. Information is a lifeblood for any business. So what are the key sources? We can look around the internal and external. So external sources can be various, the credit reference agencies. Internal, what is information we already holding about the clients, which we can review and then we can give the credit to the customer. Okay, external generated information, trade and credit reference, supplier reference. You can look around the credit worthiness can be checked, asking the customer to supply the trade reference from other supplier to whom they used to deal, and then we can get the reference. Like when you apply the job, employer need to be get the reference to, so we can get exactly to give the credit to some, can give the reference and get the reference. Okay, bank references is very important, so that's why the crucial agreement with the bank, we are always paying, we never decline the direct debit. So these are the very crucial, bank reference help us to make and check, the credit worthiness of our customer, our clients. Okay, then we can look around the internal generated information, trading history, we can look around. Age analysis, age receivables, how often the customer, if given 30 days credit and customer used to pay in 45 days, so is the 15 days is the problem. So we need to be look around because this impacts our cash flow, so that's we need to be very clear, and we should have a clear policies in place. Okay, irrecoverable debt. Yes, so how often and how many percent we have a irrecoverable debt? The debt which we can't recover it is become a bad debts, and the bad debts is of course impact, and these are the expenditures, and our expenses increase, our profit will decrease. So we need a good credit scoring policy. Our allowance, our estimate should be affected, like due to the COVID-19, maybe many people are out of the job, and due to the many people out of the job, we need to be make sure we grant the credit based on the current in scenario and the current environment, not the previous credit scoring. Okay, then 2.2 is we can look around benefit granting credit. Yes, so what are customer goodwill, increase, revenue, and cost of granting credit. Always we need to be measure those as well. So thus we need to, before we'll make the final decision either to grant credit or not grant credit. So that's all we need to look around. Okay, so based on this, many businesses entire revenue is made on the credit term, and therefore critically manage the purpose and the granting credits in order to ensure the sales are only the organization which is paid term and the time collections. That's all we need to be keep in mind. The correct evaluation of the credit risk is the most difficult and the vital. So that's we need a good knowledge about the term, what is the base rate, what is the commercial. So base rate at the moment in UK is 0.01. What is the commercial rate is 2%. So if the commercial rate is a 2%, so you can add 8% of the commercial lending rate. So that's will because that help to be. So if anybody not paying it, we can look around, add it 6 to 8% more, because that's the credit rules which we can. Okay, as we earlier mentioned, should ask the precise term. Do you consider the X Limited is a good on credit 1,000 per month for next 30 days? Remember, trade reference, customer must maintain the yes. So typical good relationship with the referees and type of the bank reference we need to be. Is it best? It is worse, or where it fall in the middle. So credit reference is provide the information about. So credit worthiness and assess the suppliers. That's all we need to be look around. The content of agency reports and other information like press, historical, financial, management accounts. All the information help us to make the decision properly. Is it we grant the credit or not grant the credit to the individual? Any question up to now, please? Okay, good. Next, now we are looking the ratios. Financial ratios, it means the measuring the performance of the company. Ratio help, and we can use the interpretation of the ratios, what is meant by, and we can set our credit policies based on the ratios, based on the industry averages. So ratios can be profit margin. We can look around asset turnover ratio, return on capital employed, gearing, earning before interest and tax. The ratios, the profit, account payable, payment period, how often people are repaying and we are receiving. So always our receivable days should be lesser and the payable should be longer, so we have a safety net. But if it's a too long payable, that will give us the bad goodwill as a company. So we need to be well aware of what impact it can be. So quick ratios is mean anything like current asset divided by current liability minus inventories. Quick ratios also known as asset test ratios. So which is always the benchmark is 1 to 1. It means £1 worth of current asset divided by £1 should be £1 worth of liability. If we have a more liability less, so that also liquidation issues can be. So those we need to be. If the current ratio is 2 to 1, £2 worth of current asset, £1 worth of liability, all we need to keep in mind the benchmark before we decide to grant the credit or not grant the credit to individual. Okay, credit scoring is the method of assessing the credit worthiness of individual or the organization. Uses statistical analysis that is used by the bank, utility companies, and insurance company and lenders to assess the ability of the individual and the organization to repay any loans. That's, we need to be. So we can calculate these ratios. We can look around the credit scoring criteria, which we already set up the benchmark. And then if it's a match, then we can give the credit. Okay, granting credit, whether to grant the request entirely, whether to grant the credit provisionally, or whether to grant the credit less than or refuse credit. And credit rating is, yes, receives posted immediately, query cleared quickly, ordered, yes, weighted again the credit limits which we need to, and credit reviews carry on, because which is based on the economic circumstances we need to be carry on reviewing. Okay, so using the credit control, business names, contract title, all this we need to be open the accounts, set up the credit limit. Like a couple of you maybe done the Sage, when we set up the customer, we can set up the term, we can set up the credit limit to give our zero credit limit be as per policy, or we check the credit check of the individual what credit score, like is it fall in 900, or is it fall 850, or is it less than 600. So you can decide like individual credit as well. The companies have the credit. We can use the credit rating agencies as well, such as Experience, Equifax, Credit Expert, and various other credit scoring agencies. Okay, then next we have a 2.3, explain the importance of liquidity. Liquidity is very important. Liquid means anything near to cash, or anything which we can convert into the cash. Inventory plus receivable days minus payable days, that show the working capital cycle. So we can calculate the ratios based on these, and then we can decide, and also cash and the bank balances and the short-term investment. So customer place order, cash received, trade, telephone calls, maybe, yes, remind letters if we do, and that will help, like not the rest, maybe just a gentle reminder, your payment due on the 30th. So if you make the early payment, you will be entitled about the prompt payment discount. Maybe the customer can pay 20 days early, then so 20 days our cash flow will be increased, because in the business is the cash is really matter. Cash is the lifeblood for business. So establish the credit status, yes, quit the credit limit. These are all the steps we can follow, which we as indicated in this picture. Okay, so yes, so we can look around the account number, age receivable analysis, who are the customer, what the balances, what the credit limit. Those are less than 30 days, 60 days, 60 between 90 days, or more than 90 days. And then we can decide to irrecoverable debt. As I mentioned earlier, irrecoverable is expense which we can't recover it. So what we need to do, we need to decide it how many irrecoverable we have this year, because if it's irrecoverable increasing, actually business is losing the cash. So we need to make sure our irrecoverable will be minimized or with the industry average. Like in industry 2% people are not paying, or somewhere 2% people are fall behind, or 2% people. So we need to decide the limits based on doubtful debts. It can be what estimate we have, what actually we have. Irrecoverable mean not going to recover. Okay, collecting debt, yes, that's we can look around invoice, fully aware of the term, invoice is correct and issues, knowledge of the customer system use, queries resolved. We need to chasing the slow payer always, phones, letters, and things. Yeah. So customer awareness of the term, we need to monthly statements. Yes, that's all we need to be really focused on, because that impact our credit scoring. Collecting debt. So methods of chasing debt is value of debt is a high personal visit. This is a very high. Oh, I was now on the way, and I just feel a quick chat. Oh, great, your business is how your business is doing. Do you know aware of you're on the 30th, your debt is due, so please yes, we really suffering are. We general reminder, not really annoyed because you're supposed to be goodwill of your company, and keeping good relationship with the business is very important as well. So address the name, individual, date, senders identifiers, sender signatures, all need to be clearly indicate in the letters, not a thread in letters. This apology and a goodwill of the letter. Telephone calls, maybe we can do email, personal visit can be, as we mentioned. And then next we have inventory. Inventory normally have three types of inventory. One is called raw material. Like if we open a fridge, we can normally find three types of inventory. Raw material like a meat, work in progress, maybe we boil it, you kept it, and then the finished good ready to eat, that the finished good is inventory. So inventory have three types. So normally finished goods is a high value, raw material is the low value, and work in progress is in the middle. So ordering inventory, when we inventory order, we need to be make sure when we enter the inventories, we need to be properly process of inventory, good delivered, delivery notes, then check, the purchase order, what was placed, a good receive note, again the purchase order, then the good receive note match with the purchase order, then check, the invoice, again the purchase order, and then good receive note, maybe we order the things different in goods, and the value and the maybe shortage of goods can be in the real world. Yes, inventory material requisition, inventory transfer, inventory return to stores. So that's all we need to be keep, so inventory is really one of, that's why is a lot of concept carry on coming. So a couple of we heard about JIT, just in time, you only buy things when you need. We heard about the term EOQ, which we'll go through. It's called economics ordered quantity. Only you order what is economically is viable for you. Like unfortunate, lot of as an individual as well, we buying when the sales is happening, even we don't need it. We can stock it because the stock, we have a lot of stock in our houses, and ultimately we struggling. And because every credit card, if you use every pound, it maybe cost you every month around 27 pence, 28 pence on the pound interest, so we need to be very well aware of what is costing us, because even if the things cheaper 50%, maybe we don't need it due to the condition, maybe we don't need to buy it. This is economics order quantity formula. Normally we use 2C, and all being explained underneath: the cost of ordering, the holding cost, and annual cost, and learn about the economics, how much order or the worth of the order economically is viable. If we do more or less, it will increase the cost. Any question? Please, if any question, you can ask. Okay, then inventory level, need to decide, well, like, if you first of all just think about, you wake up in the morning, you look in the fridge, there wasn't any milk, and this cost you, you went to the corner shop, you bought a milk, that cost you more than, what we buy. Maybe we can buy 90 pence or 1 pound from the supermarket, but the corner shop cost us 1 pound 50. We paid 50 pence extra due to we don't have a buffer stock. So these are all the formulas we can use it to maintain the safety level, and safety level is a crucial thing, to maintain in a business. Okay, so inventory, yes, different method of evaluation. It can be first in, first out. Like especially perishable goods, it should be storage in the date order. The things we bought first is go first. Last in, first out. Last we bought it, first we issue. Normally durable good, not perishables. And average is average inventory, because we different times of the period we buy, and its costs are different because the prices carry on changing, so we can charge the average price. Or this is the example of, we have on the 1st March we have a opening stock 10 unit, 10 pound each is 100 pound worth of the goods. Then we bought 30 goods, it's cost us 450. Yes, so 30 divided by 450 divided by 30, so you can see this is the 15 pound each unit. Then we issue 25 units. So we can look around the different method of, if we using first in, first out, so I need to open the first box, go first. If I need to issue 25 units, so 10 will goes this price, 10 pound each. Then 30 will goes, the remaining 15 will goes under 15 pound each, so 100 plus, So it's worth of £350 worth of the goods we issue. So always good to be first you look how much total stock you have, and then you can minus it from the total stock, from the receipt. So then if it's the first in first out, because if it's that method, so you will see there the closing exit inventory value will be different, and if you last in first out, you will see the closing inventory value is different, and overall inventory was what we issued and what is left. The value of issue you will see here. So that's the value of issue. Total value of issue is 325. And we closing inventory left 320. So total was 370. So that's the way we need to be interpreted, and we need to look around. And the inventory evaluation method we can use. Any question here? Any figures? We all okay? Good. Okay, brilliant. Next we can look around the ratios. 2.5 is use the ratio analysis, which we can look around the profitability ratios, operating ratios, and all these ratios being given, and then these ratios we can apply. We have all the formulas, and we can apply it to make the decision either to decide grant credit or not, because the ratio in analysis is very important. Then 2.1, which is the merit criteria if you want to work analysis of the inventory method using the objective of inventory management, is the major investment for many companies, and manufacturing companies can easily carry out inventory equivalent between 50 to 100% of revenue. It is therefore the essential to reduce the level of inventory held necessary to minimum. Not a lot, because it can be obsolete, it can be, and your cash can be stuck and can be huge impact on the business. So many businesses not fail due to they don't have a sale, because they only fail due to they don't have a cash. So that's why, because they can't meet the commitment with the workers, with the supplier, with the various stakeholders. If they don't have a cash, they have inventory. If you want to pay salary to somebody, you can't say you take the inventory. So that's why the inventory management is a crucial. So important inventory management, the challenges of the good inventory management to be determined the optimal reorder level. You can use the economics order quantity. You can maybe change the business model to just in time or direct business model. You take order advance and then you issue. So that's like Dell computers, they have changed the business model. They are assembling in India. They're taking order in advance, and then they deliver to customer within 21 working days. So they are taking the cash advance. They are producing in the low cost. They don't have to store the inventory. They pay, and then they manufacture, and then they sell. And normally Toyota model is changed as well, because all these Japanese are very clever to reducing the cost. So Japanese management style is more focused on reducing the cost. So that's the key focus. In every country really need to be. Any business sustainability is three things. We need to care about people, we need to care about profit, and we need to care about planet. So if we don't do it, we can't really sustain for the longer. So this is we need to be think about, and we have to do it accordingly. So that's one of the things which we need to look around more closely. Okay, then working capital is mean running capital. That's we need to be. What is the working capital management element of working capital management? Cash operating cycle, working capital ratios, all we need to. So to be better understand this topic, and if you want to work towards the distension criteria, so what I did, I copied the link for you here, which I can show you in a minute. So you can copy and paste the link. Please, that's will help you when we'll prepare the assignment, because of course this course is based on assignment, so we need to be well aware of what are the sources. So you will see their working capital all being explained, and we have a lot of example of working capital. Balance act we need to be, so advantages, disadvantages, what are the ratios we can use, how we can measure it. So all very well explained if you want, and some numbers displayed to demonstrate as well. So if you do and add example of with the numbers, that will help you achieve that will help us to be achieve our merit criteria. Yes, otherwise we not really get the merit criteria, sorry, distinction criteria will hit, so we're not going to get it. So please, when you do the assignment, so we need to be really focused. So 2.D is also is the distinction criteria recommendation. We need to draw some recommendation how we can improve it. Like, we can look around the hedging. Yes, again, the foreign currency to improve the cash flow or the risk of. We can look around the receivable, maybe discounted invoices, approach, or maybe we can give the it's called settlement discount. If anybody pay early, will be entitled to take the settlement discount, early payment discount. That's we can introduce, or other we have a good credit scoring policy or promote cash sale instead of, or we can say, cash seller is entitled for extra discount, so we can promote more cash sale instead of the credit sale. That also help, to improve our cash flow, then ultimately, which is a crucial to sustain in a business through the improving this. So that's other, the cash. This is the link we can look around and we can read. This is both, the 2D1 and 2D2 is about the working capital. Here we can draw the recommendation, adding one example. We can recommend how we can, and other is we can look around how we can improve. So that is one of the crucial element which we need to be considered before making the final decision either to go ahead or not. That is one of the crucial elements. Any question here, please? That's all today. Really, we discuss about working capital, we discuss about credit control, we look around the types of inventories and inventory evaluation method. So that's all today, and I hope speak you all during our next lesson. In between, if you have any questions, please drop me email on anjum@ukversity.co.uk. Yes, all these slides will be available on Moodle, and the link there for extra reading, please do so in your end. And in between, any concept you not get, please drop me email and I'll explain you again as well. Thanks for listening and attending. Thank you. Bye-bye.